Hello everyone, Craig Rice, Patriots Credit Services or Credit Craig. So what I am teaching today is a second video from the 5 major credit scoring factors, right? So yesterday I made a video about the highest credit scoring factor, 35% of what makes up your scores, counts for 192 points per credit bureau, payment history, right? So today what we're going to talk about is the second highest credit scoring factor, accounts for 165 points per credit bureau, and is based on your balances compared to your spending limits. So a lot of people look at that pie graph and they say, oh, okay, 30% balance is owed. They think that has anything to do with installments or other type of loans, but it has nothing to do about any part of your credit except for the credit cards. So if somebody does not have any open active credit cards, getting a credit card is very important. In most cases, if you want to increase your scores high enough, in 3 to 6 months for a mortgage, as an example, you're going to need at least one, possibly two credit cards, depending on what else you have on your credit report. So you figure if you have that pie graph, and it accounts for 550 points out of 850, right? So you have a low score of 300, a high score of 850. The difference between 300 and 850 is 550. 30% of 550, 165 points, you cannot use, or your borrower cannot use, increase or decrease that amount because of not having any credit cards. It's also the quickest way in most cases to utilize this section to increase the scores, the quickest or the fastest. So how does FICO, remember, FICO. I speak and trained on the FICO algorithm. So, when it comes down, as you could see here in the video, they score us just like high school. So A through F. So obviously A being excellent, F being very poor. How you get that A, B, C, D, or F, as you could see, is based on the balance compared to the spending limit. So the spending limit could be any amount, right? It could be 200 million or it could be $100. So the balance compared to that. So you've most likely seen, or most of you have seen, what we all see online, debt utilization ratio. The key word there is ratio. Ratio means in order to get a ratio, you need to have an A and a B, or something comparing it to something else in order to get that ratio. There's many different types of ratios, and so many different things in life that we don't even realize it. So with the second highest credit scoring factor, accounting for 165 points per credit bureau, regarding the revolving debt, is going to be the balance compared to the spending limit. So as you can see, 1 to 9% balance compared to the spending limit. When that reports to the credit bureaus, you get an A rating and you're maximizing your scores, right? So again, 1 to 9% of the spending limit. Well, the spending limit could be $100, right? So that's just $1 to $9, or $200. $18, or to $18, right? So, you're looking at something from $2 to $18. As soon as you go past $18 on a $200 spending limit credit card, 1 penny or, a piece of a percentage, you're now considered a B rating and your scores just drop. Because now you fall into that 10 to 19% debt utilization ratio. So as you go from the 9% to a 10 to 19, your scores drop, B rating. As you go from the 19% to a 20 to 29%, you're a C rating and your scores drop more. 30 to 39% is a D rating, 40% or higher is an F rating. So obviously your balances go up, scores go down. The good news is when the balances go down, scores go up. Again, the best place to get it as that A rating. You go from an F to a D, scores increase, D to a C, scores increase, and so forth. So again, paying the balances down is the quickest way to get your scores to increase. But ultimately, a lot of people say, well, I'll just pay all my balances down to a 0. That's actually a bad thing. So is it a positive in some sense? Absolutely. And let me give you an example. You have somebody who's an F rating on their credit card. They pay it down to a 0 balance. What's going to happen is they may increase 20, 30 points. But if they would have kept that 1 to 9% balance, they would increase 40, 50, 60, 70, 80, or whatever points. So your points are going to increase more if you keep a balance. Why? Well, you can't get a ratio with having a zero balance. You can't compare the number 0 to anything in order to create a ratio or anything mathematically, right? So you need to keep a balance in all credit cards. Now, is this forever? No, only in the case that you're trying to get the most amount of points per credit bureau for every 5 major scoring sections of your credit. If you're trying to be approved for a home, or you have a borrower trying to be approved for a home, we want to coach them as we do, and I'm helping you understand how to do that with your clients, is no, don't pay them to a 0. I see so many times in the what if simulator, or Wayfinder and different ones out there, that ultimately people come in, they have 5, as an example, they have 5 credit cards, they've paid their credit card balances to a 0 30 plus days ago, and they come in and they're like, I don't get it. Why is my credit score 20 points or whatever it would be below what I need for the minimum requirement? And all I do is say, hey, add 5% here, 5% there, 5% here. So they're like, add a balance? Are you kidding me? No, absolutely. And as soon as they do that, they're getting a minimum of 10 points per credit per account they add a balance to. You see people increase 50 points for adding a balance, or even more. And the reason why is it generates that second highest credit scoring factor. Now, let's take a scenario where somebody pays their credit card balance down to a 0 and they keep it at a 0 for 2 consecutive months. It pulls that account out of the scoring algorithm with FICO. There's nothing to compare, right? 0 can't be compared to anything. So you want to make sure to put a balance on every so often, but especially if you're trying to be approved for credit, make sure there's at least 1%, but no more than 9% on there. Remember, 1 penny under 1%, 1 penny above 9%, and your scores are going to drop. I hope this information helps. Ultimately, when it comes down to it, there are other ways to increase the spending limit. If you have a credit card, no late payments, and really no late payments anywhere on your credit report for the last 12 to 24 months, you can increase that spending limit. So what I mean by this is, let's say that you or your borrower has one credit card, okay, just to make it simple for you to understand, but as well as for me to explain. Let's say the spending limit is $1,000. Now, 40% or higher is an F rating. So 40% of $1,000 is $400. Let's say that account has been good paying. It's current. There's not, no past dues, no late payments, no derogatories on it. And spending limit's $1,000. Keep that in mind. And the creditor agrees to increase that spending limit. Let's say the balance is $400. Well, what happens now is if they increase the spending limit from $1,000, say, to $2,500, and now their balance is still the same, right? So they were at a 40% F rating, but all because it increased to $2,500 spending limit. They went from an F, say, to a C rating automatically that day, or when the creditor reports the balance or spending limit, new spending limit, compared to that balance to the credit bureaus, the scores increase automatically. And how many points does it increase? Well, you usually see typically 30, 40, 50 points, but I've seen many scenarios where they've increased 125 points per credit bureau, or 125 points, 80 points, 60 points, just by paying a credit card balance down. So again, the scenario is the same. It's A, B, C, D, and F. It's not 1, 2, 3, 4, 500, 1 million, or anything. The dollar amount does not matter. It's the ratio. It's the balance compared to the spending limit. A lot of people will say, well, Craig, on this $200 spending limit credit card, I'll tell them they have a high balance. And they're like, it's $80. What do you mean it's a high balance? Well, it's not exactly a high balance. A high balance compared to what your spending limit is. $80 is an F rating. Right? So you want to make sure to compare these, and we obviously do all this stuff for free when we do the analysis. If somebody doesn't have good open active credit cards, you have to get credit cards. You will not be approved for a home loan in most cases without them. You will need at least 1 or 2 installments for at least 24 months paying on time in order to get to that 620 or 640 mark. Typically, a lot of times you'll have to see some positive trade lines that were open and closed, and then 2 years on an installment, or one year on an installment. So I hope this information helps. Again, second highest credit scoring factors, balances owed on your credit cards. strictly for your credit cards, 165 points per credit bureau. Now, lastly, remember, this is still happening as the Fannie and Freddie go for or switch from a tri-merge to a bi-merge, right? And adding Vantage Score 4.0 and including FICO 10 and FICO 10T. So what's going to happen is this scoring model for the bi-merge with FICO, the mortgage scores, will be the same. But so you want to keep that in mind. But if you pay the balance to a 0 on the credit cards and remain it as a 0 or a low balance, this is also, that scenario is going to positively impact FICO 10, FICO 10T, and Vantage Score 4.0. So it's kind of a catch-22, but ultimately, when they flip the switch, it's going to be a whole new ball game, which we're going to keep you updated. Just keep following, keep see if you commented questions. Some people have been contacting me through Facebook, email, text message versus putting questions out there. Sometimes people don't like to air their dirty laundry right out there. They don't want to let people know that they may have credit issues. But again, Craig Rice, Craig, Patriots Credit Services. Thank you.